Picture a neighborhood that looks like the absolute picture of success. There is a brand new SUV sitting in the driveway, the kids have the latest smartphones, and the family goes out to dinner every weekend. But inside their wallets, 3 different credit cards are maxed out. Every month, they only pay the bare minimum, just to keep the lights on for another 30 days. This pattern of behavior is no longer an isolated story of a few irresponsible families. It is the standard operating reality for the modern American middle class. This chart shows the scale of the burden. Total American household debt has reached $18.8 trillion, the highest level in history. This gap between outward consumer wealth and record-breaking debt creates an illusion of stability. On the surface, the economy looks strong, but the foundation is increasingly hollow. It is easy to assume this record debt is driven by people splurging on luxuries they cannot afford. The data shows something different. Earlier this year, Americans actually reduced their credit card balances by $25 billion, bringing the total down to $1.25 trillion. But total household debt still went up. Think of it like a balloon. Squeezing one side to pay off credit cards simply shifted the pressure to mortgages and auto loans. Families clear short-term debt only to be weighed down by heavier, long-term structural debt. Fixing one financial leak by opening another leaves the total pressure unchanged. The debt is being mathematically displaced rather than solved, moving the strain to a different part of the budget. On the surface, there is some news that looks positive. The delinquency rate, the number of people failing to pay on time, dropped from 8.7% to 8.6%. However, having nearly 9 out of every 100 people unable to pay their bills on time is already a red flag. A 0.1% improvement on a historically high failure rate means the crisis has simply plateaued at a dangerous level. That brings us to the end of pandemic-era student loan protections, which is where the real damage is surfacing. This chart tracks the fallout. After 1 million defaults last year, 2.6 million more defaulted in the first 3 months of this year. These aren't just kids. The average age is 39, and their credit scores are plummeting by 91 points. These are established adults who were paying their bills on time before the pandemic. Their financial safety nets have finally given out. The force driving these defaults is a resurgence in inflation, which is making it impossible for the middle class to keep up. In May, inflation had 4.2%. That is a significant move away from the Federal Reserve's 2% target goal. Rising energy costs and new tariffs are eroding the real value of every paycheck. People are earning the same amount of money, but that money buys much less than it did a year ago. To fill the gap, families are now using credit cards for basic survival. They are financing groceries, gas, and medical bills through high-interest debt. When essentials are bought on credit, the household budget enters a cycle where interest payments eventually consume the ability to buy food or fuel. At the top level, the economy looks different. AI companies are attracting trillion-dollar investments, and banks are reporting record profits because interest rates are so high. But for the average worker who has fallen behind, the collection process is about to restart. This leads to wage garnishment, where loan payments are legally taken directly from your salary before you ever see it. This is the divide of 2026. Record corporate wealth is now coexisting with a middle class that is mathematically running out of room to survive. If you are in this situation, awareness is the first step toward finding a way out. First, write down every single debt and loan you have in one place. Your brain will try to avoid this numbers because of the stress, but you have to confront the total to manage it. Second, you must break the minimum payment cycle. Paying only the minimum ensures that interest will keep you in debt for decades. Third, if you are at risk of a student loan default, contact the Department of Education immediately. You need to explore rehabilitation or consolidation options before wage garnishment removes your ability to negotiate. Millions of people are currently walking this financial tightrope. Acknowledging the reality of the numbers is the only way to begin escaping the trap.